$85.70 a pound for uranium spot on Thursday. $94 a pound in the term market.
Right.
That gap is $9. It has held for the entire quarter. And this week, it got harder to argue it is anything other than a signal.
Oh, it's a massive signal. I mean, it basically demands that we rethink how we evaluate this entire energy sector.
Yeah, exactly. So, welcome to this Week in Review Deep Dive. It is Saturday, July 4th, 2026, and our theme for this week is straightforward, spot slept, term repriced.
That's the perfect way to phrase it, honestly.
Oh, right. And if you are joining us today, our mission is to take you straight into the underlying mechanics of the uranium market. We are going to explore why this market is flashing a major structural warning sign right now.
Because, if you're only looking at that flat, boring spot price, you're going to be completely deceived about what is actually happening.
100%. So to help you visualize this, I was thinking about how to describe the uranium market right now. And it feels a bit like looking at the ocean.
Okay, I like where this is going.
You look at the surface, which is the spot market, and it looks incredibly calm, like barely making a ripple.
Right.
But underneath the water, there is this massive, unstoppable submarine moving silently. And that submarine is the long-term contract market, completely displacing the currents around it.
Yeah, the ocean analogy works perfectly, but let's push it even further. That submarine isn't just moving, it's pulling the entire future of the global nuclear fuel supply chain behind it.
Right, yeah.
So the surface might be calm today, sure, but the sheer displacement of what's happening underneath is going to eventually force a huge wave to break on the surface.
Okay, let's get into the mechanics of that displacement then. Let's start with the hard numbers. Give us the lay of the land for this week.
So we need to look at two distinct metrics here. First, uranium U308 spot closed the week at roughly $85.70 per pound.
Okay.
And if you look at the weekly spot indicator from TradeTech, which, is one of the premier independent agencies that tracks these private nuclear fuel transactions.
Right, they're the gold standard for this.
Exactly. Well, they held their assessment at $86.25, completely unchanged. So spot is just sitting inside this very sleepy $84 to $87 band that has defined the entire second quarter.
Let's pause right there for a second because you mentioned U308. For anyone listening who isn't like a nuclear engineer, what are we actually pricing here?
Oh, sure. So U308 is the chemical formula for triuranium octoxide.
Okay.
In the industry, it's commonly just called yellow cake. It's the raw milled uranium powder before it gets converted or enriched into nuclear fuel.
Basically the foundational commodity of the whole cycle.
Right, exactly. So that raw material is trading around $86 on the spot market. But then you look at the long-term contract price, the term market, and it is sitting near $94 a pound.
Wow. So spot is flat, term is firm, and the spread between them is this very stubborn $8 or $9. Why does that gap matter so much?
Because honestly, these two prices are pricing two entirely different realities.
How so?
Well, the spot market is pricing the here and now. It reflects the fact that utility companies aren't in a rush to buy fuel for next month.
They're fully stocked for the immediate future.
Yeah. They are currently drawing down on inventory they secured from older, cheaper contracts that they signed years ago. Plus, there are no fresh traders pushing the price up today.
So it's basically the market for people who need raw uranium today, or I don't know, maybe next Tuesday.
Precisely. But the term market, that $94 price tag, is pricing the utility fuel plan for the years 2028 all the way through 2030.
That is a massive disconnect.
It is. What's fascinating here is that when the term market prints $8 or $9 above the spot market for an entire quarter, it is not just a trading range.
Right.
It is a queue. It is a very long line of forward demand waiting for the future to arrive. And queues in fuel markets tend to resolve toward the higher print, not the lower one.
Okay, let's unpack this, because I know what you might be thinking if you're listening to this deep dive. If I'm running a utility company, right, and the spot price is where I can buy uranium right now, and it is $9 cheaper than the long-term price,
Yep.
Why wouldn't I just be a smart buyer, ignore the term market, scoop up all that cheaper spot material, and save my company a total fortune?
I mean, it seems like the obvious arbitrage play, right?
Yeah, it feels like free money.
But it hits a brick wall when it meets the mechanical reality of how this market functions. You have to understand that the spot order book right now is incredibly shallow.
Meaning there isn't actually that much physical material available to buy at that $86 price.
Exactly. The volume of physical yellow cake just sitting around waiting to be sold on the spot market is remarkably light.
Oh, wow.
And utility companies don't buy fuel a few pounds at a time. They contract for what the industry calls tail volumes.
Tail volumes. Okay, what's that?
These are multi-million-pound requirements needed to keep a reactor running for years at the back end of the decade.
I see.
So if a major utility company rushed the shallow spot market trying to secure, say, 5 million pounds of fuel today, they wouldn't get it for $85.
They'd wipe out the whole supply.
Exactly. The sheer force of their buying would instantly drain the available supply and spike the price well over $100.
So they would basically break the very market they were trying to get a discount from.
That is the mechanical trap, yeah. The shallow order book prevents bulk buying. Now, utilities were very aggressive about securing long-term contracts between 2022 and 2024, so they have some breathing room today.
Right. They don't need to panic buy.
But when those inventories deplete, and they do return to the spot market to fill the gaps, that thin market is going to react violently.
Which means the term price of $94 is the true leading indicator for where the cycle is actually headed.
100%.
Okay, so if the future price is holding that high, it stands to reason someone must be spending serious money to capture that future value.
Right. The physical infrastructure has to adapt.
Exactly. And that naturally brings us to the first major story of the week, which is happening at the enrichment level, Urenco.
Yeah, this is where the physical reality of the fuel cycle takes center stage. We are seeing real-world capital expenditure react to that $94 term price.
Break down the Urenco news for us because this is huge.
It's massive. So Urenco USA operates the only commercial uranium enrichment facility on American soil located down in Eunice, New Mexico.
Right.
And they are executing a plan to expand their capacity by nearly 50%.
50%? That's a staggering increase.
It is. We are talking about adding 2.1 million SW of new gas centrifuge enrichment across up to 24 new cascades. Oh, and by the way, total site capacity will push above 7 million SW by the early 2030s.
Okay, I am going to stop you again because we need to define these terms so everyone can picture this. What is a SW and what is the cascade?
Sure. So SWU stands for Separative Work Unit.
Separative Work Unit.
Yeah. It is not a measurement of weight or volume. It's actually a measurement of effort.
Oh, really?
Yeah, it measures the amount of energy and effort required to separate the fissile isotope of uranium U-235, which is what we need for fuel, from the heavier non-fissile U-238.
Okay, so that's the effort. And the cascades do the actual separating.
Yes. So centrifuge is essentially a tall, highly engineered cylinder that spins uranium hexafluoride gas at supersonic speeds.
Right.
The heavier atoms get pushed to the outside wall, and the lighter atoms stay near the center. But one centrifuge isn't enough to enrich the gas to fuel-grade levels.
You have to do it over and over.
Exactly. You have to pipe the gas from one centrifuge into the next, and the next, in a massive, continuous loop. That linked network of thousands of spinning machines is called a cascade.
And Urenco is building up to 24 new ones. Plus, didn't they just bring an older one online?
Yeah, the fifth cascade of an older 700,000 SW expansion is actually already lived down there.
That sounds incredibly complex to engineer and build.
It is literally one of the most technologically demanding industrial processes on Earth. And that complexity is why the timeline is so critical. The first of these new cascades won't come online until 2032.
2032, I mean, that feels really far away. But there is a very specific geopolitical deadline colliding with this. On January 1st, 2028, the full ban on Russian low-enriched uranium, or LEU, goes into effect. The West is fully cutting off Russian supply.
That is the friction point.
Yeah.
I mean, this is the West committing actual capex, hundreds of millions of dollars, to close the enrichment gap caused by that Russian ban.
Not just a study or a memo.
Actual money. But the ban hits in 2028, and the new capacity doesn't arrive until 2032.
Okay, here's where it gets really interesting. Tell me if this analogy works for you.
Let's hear it.
It is like managing a fleet of delivery trucks for a major city. You know for a fact that a regional fuel embargo is going to hit in 2 years and the main pipeline is getting shut off. But you also just found out exactly who is building the region's only new high-capacity gas stations to replace that pipeline. The catch is the construction crew just told you the new gas pumps won't turn on for 6 years.
That captures the dilemma perfectly. You have a 4-year window where the math simply does not add up.
Yeah.
Urenco's 2032 timeline forces Every single utility company that has a fuel plan stretching through 2035 to completely reprice their enrichment risk right now, today.
Because they finally have a name for who's going to supply them.
Exactly. The market's demand curve is being modeled a decade forward. The answer to the question, who enriches America's fuel after the Russian ban, now has a definitive corporate name attached to it.
Urenco Co.
Right. But surviving that gap between 2028 and 2032 is what is keeping that term price firmly at $94.
Okay, so if Urenco in the refinery building the new gas stations, a refinery is entirely useless without crude oil.
Obviously, yeah.
Where does the raw material come from? That takes us one step backward in the supply chain, from the enrichment of the fuel to the raw yellow cake pulling out of the ground.
Yeah, you need the raw molecules before you can spin them in a centrifuge. And this week, we got clear signals from the two dominant producers of those molecules, Kazatomprom and Cameco.
What are the specific numbers they are putting out regarding their supply targets? Because I know there's been some downward revisions.
Oh, absolutely. So Kazatomprom, which is the state-owned operator in Kazakhstan and the largest producer in the world, just cut their 2026 guidance.
By how much?
They dropped their target by roughly 5%. So down from 32,777 metric tons to 29,697.
Wow.
Yeah. In practical terms, they just erased about 8 million pounds of U3O8 from the global supply plan.
And Cameco over in Canada.
Cameco's McArthur River joint venture is facing expansion delays. They are now guiding for 14 to 15 million pounds for 2025.
So if you add that up,
yeah, if you add up the cumulative 2025 and 2026 production cuts across just these two major players, you are looking at north of 20 million pounds of uranium removed from prior expectations.
okay, wait. I have to ask the obvious economic question here.
Go for it.
Wait, if the term price is a highly lucrative $94 a pound, if prices are soaring, why on earth wouldn't the biggest producers in the world pump as much volume as humanly possible to cash in? It feels counterintuitive.
Well, it's a fair pushback because in most commodity markets, high prices cure high prices, right?
Right. A high price incentivizes producers to flood the market, which eventually drives the price back down.
Exactly. But the uranium market has a very distinct, very painful history. For decades, the mining industry was plagued by relentless overproduction.
Oh, right.
They flooded the market, and it crushed prices down to levels where the miners were essentially operating at a loss just to keep the lights on.
So they learned a lesson.
Oh, they did more than learn a lesson.
Yeah.
The underlying math of the industry flipped.
What do you mean?
Every long-term contract being signed at $94 right now is being signed against the global supply curve, where Kazatomprom and Cameco are consciously running below their maximum capacity.
Why?
Because they can. I mean, they generate significantly more profit with far less operational risk by keeping supply tight and selling fewer pounds at $94 than they would by flooding the market and crashing the price to $50.
Ah, so they're acting as a disciplined duopoly.
It is a complete regime shift in the market hierarchy. Utilities are no longer dictating the terms of the fuel cycle. They're negotiating around the producer's terms.
We have firmly entered a producer's market.
Yeah. That $94 price tag is simply the cost of admission in a world where the two biggest bouncers at the door have decided to let fewer people into the club.
Okay, let me recap this for a second. We have raw supply being tightly throttled by the miners. We have a bottlenecked build-out happening on the enrichment side to dodge the Russian ban. So the supply side is constrained across the board. But a constrained supply only matters if there is ravenous demand. Where is the government and tech demand actually showing up?
This is where we pivot from the legacy nuclear industry into the future of technology and policy. And the policy side just made a very loud statement.
Right. We saw two massive demand-side updates from the government this week. First, the Department of Energy's reactor pilot program announced they are targeting this very month, July 2026, for the first criticality of an experimental reactor built by HALEU Atomics, specifically the HALEU-X.
The DOE running an accelerated timeline to get an advanced reactor online is a data point we honestly haven't seen in decades.
But before we get into why they are accelerating it, we need to clarify that physics term. What does it actually mean when a reactor reaches first criticality? It sounds like a crisis, but it's actually a milestone, right?
Yeah, it's the ultimate milestone. In nuclear physics, criticality doesn't mean something is critical in a bad way. It refers to the exact moment when a nuclear chain reaction becomes entirely self-sustaining.
Okay, so it's a balance.
Right. When an atom of uranium splits, it releases neutrons. Those neutrons hit other atoms, causing them to split. When the number of neutrons being produced perfectly equals the number of neutrons being absorbed, the reaction is stable. First criticality is the day the reactor officially has a heartbeat.
And the DOE wants that heartbeat this month for HALEU. But they aren't just pushing regulatory timelines, they are literally opening the checkbook.
Big time.
The second update is that the DOE entrenched $900 million in grants for a specific type of fuel called HALEU.
Yeah.
And that funding is flowing to Centrus, specifically their American Centrifuge Operating subsidiary, along with companies like General Matter and Orano Federal Services.
We absolutely must define HALEU here. It stands for high-assay, low-enriched uranium.
How does that differ from the fuel used in the giant cooling tower reactors we see today?
Well, standard nuclear fuel is typically enriched to about 5%, U-235.
Yeah.
HALEU is enriched much higher, usually between 5 and 20%.
Got it. So it's denser.
Because it is more concentrated, it allows you to generate significantly more power out of a much smaller physical footprint. It is the exact, specific fuel required to run the next generation of small modular reactors, or SMRs.
So what does this all mean? Why should you, as a listener who might not work in energy, care about HALEU grants and experimental microreactors?
It's all about tech.
Exactly. Here's a connection. If you are following AI and data center energy demands, you cannot separate the tech bull case from the uranium and enrichment bull case. They are permanently linked.
Absolutely. The hyperscalers, the tech giants in Silicon Valley building out massive AI infrastructure, they are betting their energy futures on these exact advanced reactors.
Right. Companies like Kairos Power, X-Energy, and ELO.
Yeah, they are designing the hardware that will power the AI revolution. But those advanced reactors are completely useless without HAU. I mean, they are multi-billion-dollar paperweights if the fuel supply chain doesn't exist.
Which explains the $900 million.
Precisely. The DOE is looking at the tech sector's commitment to advanced reactors, and they are matching it with fuel cycle funding on the enrichment side.
Wow.
The government is stepping in to ensure that when Silicon Valley finishes building these reactors, there is actually highly concentrated uranium ready to put inside them.
It is a continuous, unbroken chain. AI requires data centers. Data centers require uninterrupted baseload power. To get that power without carbon emissions, you need advanced nuclear. And to get advanced nuclear, you need HALEU enrichment and raw U3O8.
And this brings us to how the financial world is digesting all of this physical data, right?
Yeah.
Because while the physical spot market for uranium might be sleeping, the equities market is wide awake.
Let's talk about the tape. How are the stock prices of these uranium companies reacting to this structural setup?
The tape is reading much more constructively than the spot price. The financial markets are entirely ignoring that sleepy $86 spot market.
They see the bigger picture.
Yeah. They're looking at the supply constraints, the Urenco timeline, the AI demand, and they are pricing in the reality of that $94 term market.
Case in point, we saw Uranium Energy Corp, trading under the ticker UEC, up roughly 77% year-to-date. They closed the week near $10.85, riding a lot of M&A momentum.
Right. And M&A, mergers and acquisitions, is huge right now. In a market where raw uranium is this scarce, it is often faster and cheaper for a large mining company to simply buy a smaller competitor who already owns a discovered deposit.
Rather than spending a decade trying to permit and build a brand new mine from scratch.
Exactly. That M&A momentum acts as a firm floor for stock prices.
And looking at Cameco, trading under CCJ, they are holding near their year-to-date highs around $95.35.
When you see institutional equity leadership holding firm or climbing while the underlying spot commodity is flat, it tells you that institutional conviction is completely intact.
The smart money is watching the spread.
Yes. When the term contract price is at 94 and spot is at 85.70, the equities are going to price in the 94. They know the submarine is moving beneath the surface.
Okay, so as we look ahead to the rest of the summer, what are the key events we need to be watching to see how this plays out?
There are two immediate things to watch in the coming weeks. Number one is that HALEU's first criticality confirmation from the DOE.
We need to see if they actually hit that July schedule.
Right. If they do, it confirms that the political and regulatory momentum behind advanced nuclear is real and accelerating.
And the second catalyst?
The late July and early August earnings and operational updates from Kazatomprom and Cameco.
To see if that 5% cut holds.
Exactly. We need to gauge if those cuts hold steady, and we also want to hear management's commentary on the Q2 term contracting details. If either of these majors announces further supply downgrades, it will aggressively compound the tightness.
So to bring this deep dive full circle, the spot market slept, but the term market repriced.
It sure did.
Between Urenco's massive expansion, producer discipline holding over 20 million pounds off the market, and HALEU targeting criticality, the fundamental data got incredibly strong while the tape stayed flat, which is a historically unstable configuration.
It's a tightly coiled spring. And, before we wrap up, this entire setup raises a critical thought for you to mull over.
Let's hear it.
We have spent a lot of time today discussing how hyperscaler tech companies are driving advanced nuclear demand to power AI, right?
Yeah, that's the big narrative.
But if raw uranium supply is this tightly disciplined by essentially just two major miners, and enrichment is bottlenecked through highly consolidated Western players like Urenco and Centrus,
Right.
who really holds the ultimate leverage over the future of artificial intelligence?
Oh, wow. That is a fascinating shift in perspective.
I mean, is it the Silicon Valley tech giants writing the code, or is it the companies controlling the actual molecules of U308 and SWU?
It completely flips the narrative who owns the bottleneck for the next technological era.
It really does.
Well, thank you for joining us on this deep dive. Keep questioning those surface level numbers, pay attention to the currents underneath, and we will catch you next time.